Good morning and welcome to the Killik and Co market update. This morning the latest set of retail sales data for the UK has been published and the numbers came in significantly ahead of expectations. Sales for April were up 9.2% in comparison to March. We know that lots of people have been able to save significant amounts of money during lockdown, but now it seems that some people are taking the opportunity to go out and spend this money following the reopening of stores on the 12th of April. Here's a chart showing retail sales since 2018. As you can see, there were significant dips during the periods of lockdown, followed by a notable spike in the April just gone. It's also quite interesting to look specifically at online sales. So here's a chart that looks specifically at online sales. In the green, we've got the growth that's taken place in each category over the last year. And in the pink, we've got the change that has happened in the last month. So as you can see, over the last year, there has been a huge amount of growth in all categories, especially in clothing. However, in the last month, all categories have declined. And that suggests that people are now taking the opportunity to go out and spend in person now that they are allowed to. However, despite the fall in the last month, the expectation is still that online sales will remain much higher than pre-pandemic levels, and that should be good news for online retailers and also for online payments companies. Credit ratings agency Moody's published some data on bond recoveries last week, looking at how much money each bondholder was able to recover when companies went into administration. Companies or governments will issue bonds when they need to borrow money. And over the last few years, we've seen a huge rise in bond issuance because interest rates and therefore bond yields have been so low. However, the more debt a company has, the less likely each debt holder or each bondholder is to get their money back if that company gets into trouble. Moody's has analysed data for 43 different US companies that defaulted on their debts between March and September last year, and it's compared the recovery rates for the bonds to the recovery rates that occurred following the financial crisis and following the dot-com crash. There's a clear pecking order that defines who gets paid first when a company gets into trouble. Loans will be paid off first, followed by senior debt holders, followed by subordinated debt holders. On this chart here, you can see the recovery rates in dark blue for each category of bond that occurred last year, and this compares to the rates for the financial crisis and for the dot-com crash that are shown in lighter shades of blue. So as you can see, the rates that occurred last year were far below the rates that occurred in previous crises. Bonds are often assumed to be a relatively low-risk investment, and this is just a helpful reminder that not all bonds can be considered to be low risk. And finally, defence. Last week, my colleague Matthew talked about the need for more spending on cyber defence, but this week I've been looking at some data showing an increase in global military expenditure between the years 2019 and 2020, which has just been published. Have a look at this chart here, which shows global military expenditure since the year 1990. As you can see, there was a period of brief decline following the year 2010, but over the last few years, global military expenditure has very much been on the rise again. As you can see by the green components of this chart, the bulk of this spending comes from the Americas, but if you look at the pink components, you can also see that Asian expenditure has also been on the rise for a number of years now. This table here shows the top spenders in terms of individual countries. Unsurprisingly, the US is out on top, very far ahead of any other country, and below that we have China. I'd also highlight the change in military expenditures that each of these countries has undertaken between the years 2019 and 2020. So for the US, spending was up 6%, for China it was actually down 3%, but for the UK, defence expenditure was up 22%. In terms of stock market companies, there has been an increased focus on these over the last few months following a perceived increase in levels of conflict around the world. For example, there have been notable disputes between the Chinese and Indian borders, and there's also been a lot of violence on the Gaza Strip over the last few weeks. Here's the share price chart for a company called Northrop Grumman, which is a major US defence company. As you can see, the share price has had a very nice bounce over the last couple of weeks. So please do give us a call if you'd like to hear more about our thoughts on defence. Moving ahead to look at next week, we've got results out from SSE, Salesforce and Costco. That's it from us. Enjoy the weekend and we'll see you next Friday.